Welcome to the Mailbox Money Show. I am your host, Bronson Hill. This is the show where we talk about all things related to passive investing and real estate. And today we have a special guest. We've got the one and only Ken McElroy in the house. He's an amazing guy. If you don't know Ken, he has transacted over $1 billion in real estate. He has his YouTube channel. He's a rich dad advisor, has written many books on the topic of real estate, raising capital, all different sorts of books to add to the space. So really excited to have you here today, Ken. How are you?
Hey, what's happening? Good seeing you, man. Happy New Year.
Happy New Year. Absolutely. It's really excited to chat today. So I just wanted to kind of jump right into it because I know you talk a lot about real estate and relation to the economy. And you had a video come out recently that was basically like pencils down, bro. Like stop looking at deals. So why don't you just fill us in on what's happening right now, and anybody who's a real estate investor, what they should be paying attention to.
It's funny. I'm getting a lot of attention over that video, because it's, usually the internet is all sales all the time, and everybody's got I think a warped view oftentimes, or a very biased view, now that video was came out of frustration, over months and months and months of trying to buy deals, and by the way, people might not know. So I have every Tuesday, I have an investment committee call. It's 90 minutes. On that call are 7 people. And, everything leading up to that call is we have a tremendous amount of networking going on we have acquisitions in-house. We got guys flying around, meeting with brokers. We're looking at properties. They funnel up to our analysts here at our office. The analysts are carving through the numbers. We're meeting with property management. So these are not this is, I had our acquisition guy. I looked, we've done 50 offers this year. And we ended up with 2 deals. But the deals, the deals that we looked at are in the hundreds. So this is not, every single deal, Bronson, that we actually bid on, we've spent hours on, and so what we found is that, the increases in debt have basically killed a lot of things. So not everything, and we'll talk about that in a minute. But when the Fed started raising rates in, I guess it was it June?
I think it was March. Was it March of
March? Yeah, there's been 6 rate increases, I think. That's right. June we peaked at 9.1 inflation, I think, and now we're at 7.1. So, what happened was everybody's like, it's fine. June, July, August, I think the deal flow was still going. But then really the third quarter, things started to change a lot. So there started to be kind of a denial, I guess, on the seller side that the buyers were facing these higher debt costs. And they're like, hey, they're living, yesterday's number. And so there's a big difference between bid and ask. So, and by the way, this is every single week, right? We're bidding on projects, and sometimes we'll be in best and final, and sometimes, obviously there's a long lead time between when offers are due and when you're looking at them before that, and then the best and final all the way. So sometimes you're tracking a deal for 8 weeks, and so all this has been going on behind the scenes, and we are in a project that we had in escrow where the cash flow was $3 million, and it was an $800 value add per unit. Incredible property. And I knew the property. I was excited to get it into escrow. The seller was happy. They knew us. And, we were like, okay, $800 a unit value add and $3 million in cash flow was north of $100 million deal. So I want to say we had at least, somewhere between 30 and 40 million on a down payment. So let's just say it's 30 with a $3 million cash flow. That was like a 10% cash on cash,
Wow.
I was like, right on, this is going to be great. And then while we were in escrow, our debt costs went up a lot because of we're in due diligence during this time. And so the number that we got from the mortgage guys the capital markets guys changed a lot. The market had changed a lot in that 45-day, 60-day window. And it lowered our cash flow from 3 to 2. So we lost a third of our cash flow. By the way, the seller represented a deal perfectly. It was a $800 a unit value add. The expenses were pretty much what the broker said they were. The rents were where they said they were. So it's the exact same deal, but the debt costs went up so high that we now are in a position where our returns weren't what we thought they were going to be, because the cost of the loan went up so much. So we all sat down and go, well, we can't pay this price now. So we went back to the seller. Luckily, we didn't have any hard money up. And we said, the debt costs are X, and all the things have changed. And so they said, well, why don't you retrade us? Let's stay in escrow. We understand. But we chose not to, because that was somewhere in the middle of all the, we would have gotten hit on all the rest of those rate increases. Now, in hindsight, you can say, oh, it was a good decision that we made, but you never really know what rates are going to be next. But we felt like the inflation was so out of control that the Fed was going to continue to raise these rates. And we didn't want to be in a situation where our debt costs, even with a cap, the rate cap, we didn't want to be in that situation where we were facing, the rising debt costs in a value add. So we passed, and so with that, that's just one example. But the other thing, we've seen at least a 20+% price adjustment in that period of time. And so I'm like, gosh, if it's happened that quickly in 3 or 4 months, I don't really want to be in a situation next year where we're facing, some kind of an exit. The uncertainty, certainly, on the debt side, expenses are up, rents are not growing like they were. And so that's why I did that video. That's a long explanation.
Yeah. No, that was a great answer. No, I think we experienced something similar. I think anybody who's operating in the multifamily space, right about June, things started to change a bit. And we went after a couple of the biggest deals we've done, $65 million deal and a $37 million deal. And the investor sentiment changed. It was harder to raise money, obviously, for certain people, you guys have a long waiting list on your deals, but it's interesting because now what we're seeing is lending has just really changed. I mean, where it's like, we have a deal we're wrapping up, we were able to kind of lock a rate a while ago. But we're seeing sometimes 50-50, 50% LTV, where you're putting so much money down that the numbers just don't make sense anymore. So what do you think? I mean, I have an opinion on this. I'd love to know your thoughts. That the Fed has said they're going to keep raising rates for the next year, and that's what it's going to be. But historically, there's a guy named Jeff Clark from goldsilver.com. He says that historically, the last 100 years, from the time of the first rate increase to the time of the first cut, it's typically 5 to 13 months. It's never been longer than 13 months from the time of the first increase to the first cut. So that would put us at 13 months would be April. I'm wondering if in the next 3 to 6 months, just due to an inflation or due to some other issues, they might need to start cutting rates. Do you think that that's a possibility? I think they're just going to keep raising until this gets really painful and just everything just shuts down kind of in the multifamily space.
Well, first of all, I hope Jeff's right. You know what I mean? I want to be wrong. I mean that, but the way I see it is a little differently. So I see, 9.1% inflation in June, 7.1 right now. Okay. 6 rate increases. We've seen 2% decline in inflation. That's it.
Right.
So far. Now, there is lag, you know what I mean? There's definitely lag, and Jeff's correct there. So, I believe, I'd be very surprised if inflation got down below, say, 4% next year. Now, I hope I'm wrong, but what I mean by that is I do believe that we're going to see rate increases through most of the year. Obviously, I think the Fed meets 3 times before summer. So I think we're going to see rate increases lower, 50 basis points, 25 basis points, whatever it might be. I don't think we're going to see as aggressive. So I do think we're going to see that in that first half of this year. And then who knows, and trust me, I hope I'm wrong on this, because, the deals are dying every day as a result of these high debt costs. But the reason I did the pencils down video, Bronson, is because I don't know. And I didn't want to put my investors in a situation of uncertainty. I want to know what my debt costs are going to be in 2023, because it's such a huge thing. I can do an okay job managing, expenses and income, through our property management company that we have in-house. But the debt, it's such a variable on the cash flow that we just are a little bit frustrated going into next year.
Yeah, no, I know you guys do a lot of fixed rate debt, which obviously fixed rate is much more preferable. A lot of people I know in a lot of our deals have been bridge debt with some sort of interest rate cap that we were, expecting to be reasonable. Now those interest rate caps have gotten to be 20 times or more expensive than they were. So it's eating into some of the cash flow on these deals. And I think actually, if you look at the large multifamily space, it's somewhere about 85-90%. I could be wrong on this, but it's a high percentage of these loans, even from REITs and other things, are these kind of 2 to 3 year type of bridge situation. So what happens in the next, 12 months as rates continue to climb? And do you think there's a lot of foreclosures, things pick up, or do people lose deals? Or do you think that, I guess I would also ask, who's most at risk in that situation? Is it the Class A kind of a brand new properties if rents start declining, or is it more of the value add people that are doing like what we're doing, kind of B and C class value add stuff? So a couple questions in there.
Yeah, great one. Well, a couple things. One, first of all, I believe that anybody that has any kind of exit that they have to have in the next 12 months are at risk. So let's talk about what the exits might be. An exit could be a loan maturity. It might be that their equity partner wants their money. Like you're starting to see these redemption issues, at the BlackRock level, and, where investors are saying, we want our money. So,
Right.
those are real, those are, so if Blackstone, let's say, is giving you and I money and they're having pressure from their investors, that would mean that there's pressure on an exit. And then guys like us, the operators, are beholden to the equity. So that's an issue. I think expiring rate cap, is an issue. So you mentioned the bridge. A lot of stuff that got financed in the last 2 to 3 years was all bridge. So a lot of people that were doing a lot of bridge, one of the things the first thing I looked at, earlier this year was, when do our rate caps expire? Because those rate caps are 3 years, I think. So, so all that stuff, is going to be, is going to determine, what's going to happen. The other issue is going to be the rate increases. So let's talk about new construction. So if you're if you're in the middle of a new construction project, or you're done and you're 30-40% occupied, you're not putting permanent debt on there, and you're getting killed from your construction loan. Construction loans are floating debt. The reason you don't get a construction loan with a fixed rate debt is because you don't have a physical property that's done, right. So,
Right.
So there's a lot of those scenarios. I think you're going to see a lot of construction projects are definitely pencils down, because they have labor issues, they have supply issues, they have now construction debt issues and timing. I know on some of our projects, we have had delays. We haven't been able to get concrete. We haven't been able to get microwaves, and things that were traditionally normal are not normal. Even though they're getting better, and everybody's like, oh, well, lumber's back down, you should be good. There's like 1,000 components.
Right.
that go on in a project. So, I think, there's going to be a number of scenarios, and if you don't need to, like us, let's say, we don't have to sell anything in 2023, 1000%, we already know. But, not everyone's in that situation, and so those deals, I don't think that we're at the distress level. I don't think you're going to get into default. There's a lot of dry powder out there. There's a lot of people looking for those, early on. The question is going to be, if I'm going to buy a deal from you, what's my fixed debt going to be? What's my price? So you might be selling me something at 3.5 or 4, but I'm probably going to be over 6, right?
Right.
So that's going to be the issue, right?
Right. So it changes. Yeah. It's just, I've heard this too, that until the debt market really stabilizes, it's hard to do deals. And you mentioned something as well that, there's a Bloomberg actually came out with an article and said there's $5 trillion in American savings on the sideline, which is 5 times the amount that's just in people's bank accounts that there were 2 or 3 years ago. So I wonder, is that money just going to continue to sit there, or if there is a shift at some point? I mean, there's conversation, but it could get pretty bad for a lot of folks. But let me ask you a question, because again, on paper, we've paid millions of dollars of prepayment penalties by having fixed rate debt. I know you hold long enough that, as an operator, there's a benefit to just kind of hold indefinitely or continue to do value add over time. But if I continue to hold, or let's say I have a property I'm planning to hold for 5 years as an operator, and then in 2-3 years in, it's like it makes sense to sell. I'm paying those prepayment penalties, which for those that aren't familiar, it's just basically a penalty that if you have to pay off this loan or sell early, you could pay millions of dollars in penalties. So there is some benefit to having bridge. So do you guys only do kind of fixed long-term debt? Is it agency debt? Is it HUD loans? Like what kind of stuff are you doing? Or is there some of your loans that are bridge debt?
Yeah, so good question. So, we've done HUD, plenty of HUD. We have some bridge where we have caps on them, on any kind of value add, but the overwhelming majority of stuff is agency. So I'll just explain to everybody, your audience, what happens is if let's say I did 1,000 units and my fixed debt was 4%. Well, there are buyers for all that paper. There are people that want that kind of debt, so they package it up in a security and they sell it. So now all of a sudden there are people that are relying on that money, being paid out. So when rates go down, then obviously that prepayment penalty is more, right?
Right.
Because, if I can now get 3% debt, but I'm paying 4, I want to get out of 4. So typically that prepayment penalty. So we went through that period of time where you actually pay off a prepayment, but you get the 3%, let's say. Now we're going into the opposite where, you might have that 4 and rates are at 6. Oddly enough, those same people that are holding on to that 4% debt, they're like, okay, we'll get a little smaller prepayment, we'll get paid out, but now we can get into 6% debt. So as the interest rates go up, it actually does help the prepayment issue. You still have it with whatever terms you have in your documents, but that's probably the only good thing. But the problem is, in this case, we're actually replacing it at a higher number, right?
Right. Yeah, absolutely. Yeah. It's just an interesting conversation, because I've noticed there's been people that, are kind of on both sides of that obviously long-term fixed is most ideal, but in some situations, it's just in the last few years, it's made sense to either sell or refinance early. On one of your videos, by the time this comes out, we probably have already released this video. You talk about the lag effect. Can you talk a little bit about the lag effect and what that is?
Yeah. So I haven't even done that video yet, actually. But I know because I'm fascinated with this, right? I'm like you, why aren't we, seeing this? And so there's all kinds of lag. So this is where my head is on this at the moment. But, an interest rate that my son got a Amex this week, he's 21, right? And so I was like, uh-oh, And so I go to him, I go, so what happens if you don't pay the balance? He looks it up, it's 26%.
Wow.
So that is immediate, so immediate. You have $1,000 on that thing, you're paying 26%. Best Buy, a car, those kinds of things affect those, that's immediate. There's a lag on a lot of other things, specifically real estate, so the lag effect on real estate is very different, because what it's going to do is the first thing is refinances went down. We know that new originations went down. And then now we're starting to see, sales of residential and commercial have went down. That's created cap rates to go up because as I explained earlier, in that scenario where I only got 2 million in cash flow versus 3, I'm going to offer less. I would have offered less if it was 2. So, so all that stuff is starting to, that's lag. And then lag is going to be in, we're seeing, Danielle is my wife is looking at, she's hooked on this real estate investing thing, but she loves these little $500,000 homes in Scottsdale because the rents are, for a month on a home, and the math works really well for her.
Yeah.
So there was a property at $699, no HOA, big lot that that 6 weeks ago was $699. Today it's $599. So they've lowered it 50 grand, over the last 6 weeks, or I'm sorry, twice. And she's like, I think it's going to continue to go down, because the interest costs are going up. And so that's all lag, and so you're starting to see price decreases. You're starting to see that kind of stuff. It's not necessarily immediate. And so I see that continuing, for a while. And then the other lag is I own an office building. We have a big mortgage company in there. They came to we have a partner that is in charge of all the leasing, and they're down to 3,000 feet. So, and so because they don't have, they're like, hey, we don't see us doing a lot of, so that's lag. So that's going to affect office rents and office occupancy and, title companies, insurance agents, home builders. So all that stuff's lag. And then in addition to that, anything that's being built right now I'm guaranteeing you that if somebody started building something a year ago and they're finishing or in the middle of it, it costs them more and it's financed higher. So, those are all lag things. And so we have yet to be, so all that, to your point, I guess Jeff Clark mentioned it, there's a 5 to 13 month lag before this starts to really show up. And I tell everybody, if we're in the 9-inning game, I think we're in the 2nd or the 3rd inning.
Wow.
Yeah, I really think.
Yeah, it's really interesting, the idea of lag, and just when, a lot of people look back to 2008, 2009, or even 2007, see, there was a single family crash really, and houses even in Phoenix, some of them were going for $30,000, $40,000, $50,000 in certain parts of Phoenix. And, of course, those are worth, many more times that now. But at least in Los Angeles, where I live, the low in single family housing was not until the first quarter of 2012. So obviously that was a different situation, but it took a long time for things to really shake out. And so and I think there's some differences about now than there were then, where, like we talked about, the flood of cash, right? All this money's on the sidelines that's there. So I want to actually ask you this, Ken, because a lot of our listeners are like, okay, and I appreciate you being honest, because a lot of people are just like, hey, multifamily, yeah, rah, rah, rah. I still think, there could be a chance there's a pivot or something happens in the next 3 to 6 months. I'm hoping on, something like that. But what are the good options for investors? Because inflation is high. If I'm holding cash, it could be 7% inflation. It could be 15% plus inflation if you look at shadow stats. So what is the right, move? Is it holding some cash and investing in certain things? Like, what assets do you like right now?
Yeah, it's a great question. So I'm still bullish on multifamily. I mean that, like we're, I literally was with my acquisition guy right before this call, we are still active. We're still looking at deals. He's still looking at deals. So what we're looking at is deals that we can step into fixed rate debt. So, because to your point earlier, we're seeing 50% loan to value anyway. So, if we can step into, these commercial deals, are assumable, right?
Right.
So depending on how much time you have left on them. So if somebody's got a 3.5% loan or 4 even, and the numbers make sense, then that's their loan is now an asset, really. A lot better than you're going to get. That's one thing that we're doing. The other thing is, we're baking in what we think the rates are going to be, and we're underwriting it to what we would offer based on our cash flow. So we've been very disciplined in we still need to provide that return to the investor, and the investor needs a certain cash flow each and every month. And if it doesn't do that, then we pass. So we're still active. And, we almost had a deal last week in San Antonio, and, there were 21 people investing in offers, and then we got to the final 2. We ended up losing it, which is fine. But we just stuck to our guns, because we knew the number, we knew what we needed to pay out to our investor. So sellers' expectations are coming down. I think the first quarter they're going to come down a lot. And to your point, if they have to get out of something next year, the smart ones are going to rip the Band-Aid off early, and those deals are going to hit the market. So we're, obviously we're land banking. There's still an incredible shortage. Don't forget about that. Like residential and multifamily are needed badly. And so that's not going away. What's happening is, maybe this could be a short dip. What I mean short could be a year, maybe 2. So we're also stockpiling cash. We want to be in a situation where that could benefit us later.
Yeah, I know that makes a lot of sense. Having availability. I'm about 90% of my net worth, I'd say, is in multifamily. I imagine you have a high percentage of your net worth in multifamily.
Yeah.
If you were someone that is saying, hey, maybe I'm 30% in multifamily or 50%, what would you do with the remaining 50 or 70%? Obviously, no specific advice, but just what are some other considerations?
Yeah. So, I think, you got to look at the trends, what are people doing? So obviously anything that has anything to do with, the baby boomer generation, anything like, what I mean? Like that train's been coming. So, senior things, I have friends that are opening, medical stores. I think that, anything around any senior communities, anything like that. I think the assisted care facilities are a little expensive. So I personally like the active senior, market. So that's something we're looking at. Still housing, but very specific. We're obviously, I think there's a lot of interesting things happening around gold and silver right now, especially if Putin comes out and starts taking, the oil, gold, for his oil. I don't know if you dug into that at all, but
I haven't.
You take a look.
Sounds interesting.
No, that's interesting. I don't really look at gold as an investment, for cash flow, but there's a fair amount of articles around this issue. What would happen, as oil gets traded in US dollars
right
everywhere. So, Nixon made that deal a long time ago with Saudis in the 70s, still happening today. And I think that a lot of people are upset, the world's reserve currency, the dollar and all that stuff. And I'm not far down the rabbit hole like some people on the conspiracy side, but we just got done. I just got done. I was in Doha, Dubai, Singapore. I was in Indonesia and Thailand all in the last 2 months. And the dollar goes a long way in those countries right now, and people are getting killed. So when you look at it from the foreign in, it's not necessarily a good thing, right? When you look at it from the US out, it's like awesome, but so the world looks at the US dollar very differently than we look at the US dollar. If you live here, I guess, what do we call ourselves? The modern day Romans, so but and so the point is, I do think that there's some uncertainty around that with regard to gold and silver specifically, and the articles that I read specifically said that if that happens, gold could get repriced to 3,600 an ounce. By the way, I'm not a gold and silver guy, like, you know what I mean? Like, I do know Mike Maloney, and I have lots of friends in it, but I've been buying gold forever as a hedge against the dollar, and but it's the gold price has gone like that, but I don't look at it because I'm not selling gold. But so that's something that we're looking at. I think anything that has to do with energy, we're looking at. You just look at some of the trends. I've gotten involved pretty in a CBD company, a startup. Well, now it's not a startup anymore. I guess it's 3 years now. That is already the #1 CBD brand in the US. So they just consolidated all these small companies, and now they're the biggest. I think tech, you got to be careful of. We're certainly looking at anything along that line. But the fundamentals, I think the blocking and tackling are, you just got to stick with that, and where are the trends and where are the migration patterns going, online education, that kind of stuff,
Yeah, that's awesome. I really appreciate. There's a lot of nuggets there, man. I really didn't really understand gold and silver until I went to the investor summit with the real estate guys a number of years ago, and it just got my eyes about the monetary kind of that really it is money, right? Gold and silver are money versus currency they can just create more of. But energy, CBD, senior housing, what are the trends? I love it. I wanted to ask you, Ken, kind of for the last segment here. I think your story and your biography is so fascinating that you over 25 years. Property management, investing. And I always try to ask people that, I admire just, when you look back at your younger self, and obviously you've done a lot of things right, that you'd say I do, a lot of things the exact same that I've done. But, as far as when you look back, maybe you're 20, maybe your kids are, and I guess your boys are in their 20s or about that age. So what advice would you give to someone who's, in their 20s saying, hey, I really want to grow my wealth. I want to get educated. What advice would you give?
Yeah, so there's a couple things. One, I think people are fascinated with the capital gain strategy, where they buy something. I've never been able to crack this or figure out why. I guess, they buy, let's say, a house for 100 and sell it for 150, and then they do it again, and it goes from 150 to 200. And, the flipper mentality, or, they're quick to sell. And by the way, Wall Street has taught that. They believe in that. When you take your money from a big group, doesn't matter who, like, they want it back in 3 years, let's say. So so that managed money is I call it short term. And so I think generally just wrapping your head around a longer, the long game, and so I got caught into this myself. So in the early days, when you don't have much and you make a bunch of money on something, you're like, Jesus, I want to go do that. And I want to go buy a Ferrari,
Right.
I get it. I want to upgrade. I want to go on a trip, whatever it is. I completely understand. But I look back at the stuff that I sold, in my 30s, let's say, I wish I still owned it,
Yeah.
And so when I got to the point, I would say about 2005, I had just finished this incredible condo conversion. I had a whole business that did condo conversions, and we did thousands of them. I mean, I had the lending company, I was the broker, I had a condo company, I set up a condo management company. I had all this, I had the whole thing vertical. We were selling them to investors, and we were doing 50 a month, and we were cranking. And then at the end, guess what I owned? Zero.
Nothing.
It was crazy to think, right? I'd flown all over the place and, buy these big projects and then condo them. And then, I own the models, you know what I mean? Because I would always buy the models in the beginning. So, but I was like tired. I made a bunch of money. I paid a lot of tax, and I didn't really own a lot of like passive income. And that was kind of the aha moment. I said, I'm not going to do this again. I'm going to play the long game. The problem with the long game, Bronson, is you don't get that short-term satisfaction. So you gotta, the investor gets paid first, and then you get paid second. And that's just the way it is, right? So luckily at that time I had cash, so I was also on both sides. But but that strategy really paid off for me, because at some point you get the investors their money back, and now you're in all the deals, and you're cash flowing in all the deals, and and you don't owe anything to investors anymore, because the property has paid them all back. And that's the position we're in now. We've been in for a while, at least 10 years, where we have millions coming out every month in free cash flow, and I don't even know what we have in equity, at least 700 or 800 million maybe. So, and of course, if we sold that, we would get all that, but then we would lose all that cash flow. So, but that's the discipline part, right? And so at this point now, like Ross and I, we decided when I always sit around and go, hey, this one's got 30, 40 million in equity. You want to put some new debt on, and then we take a look at it, and we say, yeah, let's do that. So we just did a cash out refi a month ago. We locked at 5.5, 10 years interest only. And we pulled, what did we pull out? Well, Ross and I each got 2 million. And then we distributed a whole bunch of others to the investors, but Ross and I, we got 4 million between us. So 2 each, tax free, so that's the position we're in now. And we still own the building, right? And we're doing a value add on it, right? It's a property that we've owned for 15 years. So that's what we're dealing with now. And and so I would say to my younger self, I wish I would have done that earlier. I wish I would have held on to some of those early deals. I was, the great analogy is, what did your parents pay for their house? Everybody knows that number, right? So, what are their, house you grew up in, you know what I mean? And and you're just like, gosh, it's true, right? Inflation does take things, it goes like this. And, not like right now we're seeing declining real estate, but over a period of time, you can do very, very, very well. So even in this period of time, if you can hold deals that you've bought and survive that, these dips, you're going to be good.
Yeah, that's I talk to a lot of people, and I see, my background is medical device sales. I did that for 10 years, and it's very similar to being like a real estate agent or a flipper, in that you make a lot of money through transactions, right? You sell widgets or medical stuff and you get paid for that, same as flipping houses or same as doing other things, but you get taxed terribly, just like you do with this other kind of shorter term real estate stuff. And so, it is a long play. And that's why when I started doing this, it was like my net worth grew over last 3 or 4 years by 20x, but the cash flow didn't increase. So that takes time to kind of get going, but as long as you keep reinvesting, keep putting it back out there, but it's a different game, because then you can play you're not paying taxes. You're really looking at long-term wealth rather than short-term gains. And it can be hard for people to pull off in the beginning, because if you had a job and you're trying to switch, it doesn't really, especially as a syndicator, if you're doing it right, it doesn't always pay a lot in cash flow. But you're kind of putting these big nest egg kind of down the road.
Yeah. And I know exactly what you're going through right now, because it's frustrating, especially when you have all this equity and you have low cash flow. And it's easy to sell off a nugget, and that's the part, that's, we always, as we always solve to the investor first. And so we just make sure that, we want to make sure that they're taken care of and covered and paid off. But then after that, it becomes a situation where, why would you sell now? Right. You put together what my friend calls the golden goose. You've got the golden goose producing each and every month, as long as you manage them well. And so now, yes, you have all that equity, but what am I going to do? Sell and then turn that over to a bunch of financial planners, and then go meet with them and get in bonds and stocks and, get all, go play golf. I'd rather shoot myself.
Yeah, no, that makes a lot of sense. No, I love, I think, you obviously have been doing this for a very long time, but it's amazing how multifamily is such a solid asset over time. Well, Ken, I just want to say I really appreciate you, not only obviously what you've done in your business for investors, as well as your YouTube channel, but just your really heart to really care for people. I just see you really in this space as really trying to help everybody, trying to help investors, trying to help people getting started, and just your heart is just really wanting to try to really help people along, because we know that people will be much better off if they get this rather than trusting a financial advisor or doing something else. I don't think it matters if you have 50K or you've got 5 million. It's like you're better if you educate yourself and you find something to do. So I just wanted to say thank you for coming on the show today. I just really appreciate you. What's a way people can follow what you're doing and connect with you and learn about your stuff?
I think you just go to kenmcroi.com. So KenMcElroy.com. Everything's there. The podcast is there. The YouTube channel's there. Obviously, we do a mastermind with George and Jason, which is great. Contact me if you guys are interested on that. We do 4, these are people who want direct access, so that's a lot of fun. We got our Limitless conference this year in Scottsdale, the 15th. Last year we sold out. We should have around 2,000 people, and it's more entrepreneur and business based. So we got that coming up, and so I'm having a blast on all of this stuff. And as I don't want to be the retired guy sitting at home. You know what I mean? I'd rather be right in the mix of it.
Yeah, absolutely. Well, I appreciate you, Ken. Thanks so much for being here today, and thanks again, man.
You bet, Bronson. Good chatting with you.
So this was a really fun interview. Obviously, Ken is just an icon in the space. I don't know what to say about him. He's really been around for a long time, and he really has a heart to help people. And I love what he said, both about multifamily, that even with all of these headwinds, multifamily is still an awesome place to be. So if you have capital, it's a great idea to look for great sponsors. We're doing deals in the multifamily space now. We're wrapping some stuff up. We're also looking, like he talked about, alternative assets, right? Looking into other things outside of multifamily, which actually is a alternative asset itself. But looking in stuff in precious metals. I do a fair amount of precious metals personally. There's also stuff in the mining space there. He talked about CBD, the energy space, which is really interesting, both for the upside as a commodity, as well as the tax benefits in there. And then he talked about senior housing or active senior stuff that's just around senior activities, that's something that's really important. So I love that. And then, I just loved how he is just kind of sharing what he sees happening. Like there's no fluff. He's not trying to sell anything. And I think that's very unique in the space. So thanks, Ken, for that. And I wanted to know from each of you, what was the biggest thing that you got out of this episode? If you haven't given us a 5-star review on the mailbox on iTunes, we're asking everybody right now to go and to leave a review. We will read some of those reviews on this show. But if you haven't joined our investment club, we are always doing new deals. You can find out more about that at Bronson Equity. And I wish each of you the very best in this holiday season and investing and in the new year. And thanks for taking the time to educate yourself. We look forward to seeing you on the next episode of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.